Very good afternoon to all the viewers who have joined in today. Welcome to this webinar on value investing, and we will also discuss our HDFC Value Fund. Anand Laddha, who is our fund manager, is here with us to discuss the same in detail. Before I hand it over to Anand, just want to set up a brief background. Um, I mean, the biggest question faced by an investor, typically, what's the biggest dilemma that an investor has, and who's an equity investor, is that is this the right time to invest? Are the market expensive? Are the PEs of the indices very high? If I invest, which sector looks cheaper? Uh, then drill down to say maybe large caps versus mid cap, small cap question arises whether large cap is attractive or small cap is attractive, or within a sector, which are the stocks. Typically, a direct stock investor goes through a lot in their mind. On the other hand, a mutual fund investor, typically, we'll assume that a mutual fund investor has done a little bit of asset allocation. So the question as to whether the markets are expensive, how do you go about assessing the value of the market, etc. A lot of that problem gets solved once we choose a mutual fund, because you're not investing in one stock, because more often than not, or almost in all circumstances, a mutual fund portfolio gives you a set of stocks. I mean, diversified set of stocks. We'll assume that the asset allocation is also taken care of, that you are not investing too much into equities and also not too less into equities. You are thinking long term. I mean, you are not investing in, say, for 6 months, 3 months, etc. And say maybe 3 years, 5 years, 10 years for long term wealth creation and achievement of your goals, you are choosing equities. And also, if you are doing SIP, a lot of these risks are taken care of, especially the question as to valuations, etc. If you go wrong on that, a lot of risks are kind of managed. However, the question still arises whether the markets are expensive. So that we will discuss here. And there is a fund that we have, which is HDFC Value Fund. It used to be called, in its previous avatar, it used to be something called a Capital Builder Value Fund. It was still value-oriented approach that was there, but because of the categorization and requirement of naming a fund to its aligned to its category, required our name to be changed as Value Fund. Anand Laddha took over about a year back, and let me tell you, the performance has been really good. I mean, the fund has been doing well vis-a-vis its benchmark over the last 1 year or so. And so that's what we want to understand in detail from Anand as to how he has been managing the portfolio, what is the positioning, etc. That we will discuss as we progress to with the call. But the first part, I would like Anand to discuss a little bit about the markets, especially the valuation questions. Which segment of the market, which sectors, whether the overall markets, especially we are talking of various risks, right? And what a day we have chosen for this call. The markets are up sharply, thanks to some news that came over the weekend on GST, and also India has been upgraded in terms of its sovereign rating by S&P. That came last week after some 17 years of a gap of 17 years. So a lot of good news is there. India is still a growing economy. Earnings will grow over a period of time. But at this point, how do we look at the market? So with all these questions in mind, I invite Anand to take over. The floor is yours. Anand, you can start with the overall market outlook and proceed from there.
Thanks, Ram. Hi, everyone. Good evening, and thanks for spending time with us. It's been very heavy rain at Mumbai, at least, and we can hear that almost all public offices are looking to close down. And I'm really thankful for everyone to spend time and to listen. Uh, so I'll cover this presentation in two, three parts. I'll give a little brief about the Indian market, Indian economy, and in the second part, I will cover a little bit of equity market valuations. And towards the end, I'll explain in detail what we are doing in a value fund, This is a very old fund of ours, almost like 15, 20 years of existence. And despite this multiple fund manager changes at our end, this fund has been able to beat the benchmark. To give a very basic view, if you look at, while this chart has been very common in all our presentation, if you look at, this is a very important and chart. This just highlight that the real GDP growth in India has been inching up every decade, from 4.6 to 5.5, 5.5 to 6.4 to 7, and in last 5 years it has again come down. The only reason it has come down because the COVID period is included. If you look at over a broader period of time, our real economy has been growing, and add to that inflation, the normal GDP has been growing upward of 10%. While this year inflation has been quite subdued, therefore we believe our nominal GDP growth will be at 9.5 to 10%. And despite all the challenges the economy has faced during each of the decade, economy has been growing, which clearly means that India, being a beneficiary of a large population, large consumption population, and underinvested in economy, even the capital investment continues to grow, which is why, despite all the challenges, our nominal GDP has been growing at 10% or plus of upward. And that gives you confidence that despite any uncertainty like the tariff uncertainty, geopolitical tension, despite all that, we believe over a medium term, our economy will continue to grow. Real GDP at 6 to 7%, inflation at 3 to 4%, 10% nominal GDP. While everyone is focusing on inflation, I just want to say that inflation for a country like India is very good. Marginally higher inflation is very good for India because if you look at our country, we are a pyramid shaped economy. Bulk of the earning masses are at the bottom, and towards the top it is very skewed. Just to give an example, only 1 million people files income tax return more than 50 lakh rupee of income. And therefore, if the inflation remains very high, which means the annual wage increase or the salary increase in India would remain in line with the inflation. And therefore, marginally higher inflation is good for India. Uh, the another piece, which another piece of the economy which is into very good shape, has been the banking system. I think for any economy to do very well, its banking system need to do very well or need to be in a very good shape. Today, if I have to look at long back history across time period, across multiple lending cycle, we are in the best in every parameter. You look at net NPA, look at capital adequacy, look at profitability, all are in good shape. Today, our bank's balance sheet are so clean up, so under leveraged that we can support the economic growth for next 5 years without any need of capital for the banking system. This is both good and bad in the sense, generally bank stocks are valued on price to book value, and if they are raising capital, it lead to higher growth in the book value. But if you look at, which is why it said that then if capital banks are well capitalized, they don't need the capital, which means no capital raising, so book value creation will be in line with the ROE. So it's bad in that context, but it is good in the context that a lot of changes happen in the banking space. And so in the past, we only had a CIBIL. Now you have account aggregator. Now you have Acrylic. All that will ensure that NPAs are recognized on time. In the case of individuals, account aggregator gives all your data. RBI has become proactive. Uh, and if you could see the small MFI cycle, which we had seen, the cycle in the unsecured is RBI the one who had recognized it one. So RBI has also become proactive. And lastly, the UPI has done a very good wonders for India. Our P2M, which is payment to merchant, which has been a good benchmark to look at the economy, has seen digital payment has penetrated very significantly. If I had to look at that, compare that with US, if you look at P2M as a percentage of private final consumption, it is at 60-65%. We are already at 48%. And given the way the UPI is growing in a maybe in a 2 year, 3 year time, we should be very close to US. That gives confidence that any shock in the economy can be well absorbed by the banking system. Even if a Trump tariff comes in, it would have a little bit of impact on sectors which are high employee, like the textile, gems and jewelry, leather. And if you look at the bank's exposure to these sectors are not very large. Second, even if some NPA, some restriction come happens, it will be very well absorbed and it won't have any shock to the system. So economy is doing very fine. Banking systems are doing very fine. So the concern or so if you look at macro, India is doing very great. Inflation is low, economic growth is very fine, banking system liquidity is very fine, bank healths are very fine. The only concern remains is the micro India not doing very well. And I think if you look at urban consumption has slowed down materially. If you look at the quarterly numbers of Q1 numbers of all the companies which are announced number, you could see moderation in everywhere. You could see GST collection moderating, you could see registration moderating. Despite so many listed real estate company we have and everyone showing that they have done so much of sales, housing loan growth has been very low, which clearly indicates that bulk of the sales has happened in higher ticket housing, and which generally doesn't generally a guy buying a 10 crore rupee house doesn't take a home loan. So what has happened in India is a fact that wealth creation has been very high. Macro has done very well, equity markets has done very well, gold has done very well, real estate has done very well. So a section of the population has done extremely well, whereas another section of the population which was impacted during COVID time, which is a lower middle class or middle class, that has seen the impact. In my next slide, I'll just show you what are the data point, which are quick data point to show that how the economy impacted. So if you look at the home loan part, which is in the red line, home loan growth has been significantly slower. It is slower than the real estate sales. Yeah. Personal loan credit growth has slowed down materially because of the challenge of the unsecured side and also the fact that RBI has done a lot of tightening for the banking systems. Personal vehicles growth has slowed down. Two-wheeler has been slowing down. The only green point was the tractor sales has been very, very well. And therefore, in this backdrop, if you see the economy is slowing down, the micro is slowing down, and what the government has done or what the regulator has done. If you look at, there are two things which has happened. One, RBI, whenever there was change on guard, they have changed a lot of liquidity. They have pumped in a lot of liquidity into a system. The RBI has cut repo rate by 100 basis point, has cut CRR, so that is enough space for the bank to lend further. Had reduced the risk weight on the MFI loan, has reduced the risk weight on banks lending to NBFC. Lot of clarification has been given on gold loan. Even the proposed 5% provisioning on infra loan has been reduced. So what it means that this is for the first time that the regulator is doing everything upfront. They are cognizant of the fact that the micro India is slowing down and we need to do something. From his side, regulator has pumped in a lot of liquidity. And this has resulted in home loans coming down to 7.5%, interest rate getting reduced. And in this festive season, everyone is hopeful. We are also hopeful that economy will do pick up. Yesterday on Independence Day, I think the Prime Minister, Honorable Prime Minister, also announced or indicated that they were looking at rationalizing the GST. That will be another bazooka for supporting the consumption and economy. So last 6 months, if you see, government directly and indirectly wanted the consumption growth to improve, and therefore they have been looking to support consumption in a very manner. First, it came with the income tax, then it came the banking system liquidity, now the GST rate cut. All this, so income tax will add another 1 lakh rupee to individual, will save a lot of money in the hands of individual. This GST bazooka could be in anywhere between 1 to 1.5 lakh crore of benefit to the individual or to the middle class family, which will also support this. Yeah. So all this would support the economic growth. So if you look at our economy, 60%, 65% is consumption, and now from here on, given second half in India is generally a festive season, we would see more of consumption demand coming back, and capacity utilization at various factors will start improving. So when I said the macro was very good, micro had some problems, some challenges, but there are government looking at it, regulator looking at it, and therefore that gives hope to us that micro would start doing very well from second half. Second part of the economy is the investment. Uh, if you look at the investment has three, four components. One, both state and the central government spending. Second, private corporate spending. And third, the real individual spending. Government capex has been affronted this year. If you look at the YOY growth in government capex has been very high. And similarly, despite so many measures announced by the state government in terms of distribution of money for election like Ladke Behna in Maharashtra, Pyari Behna in MP, despite that, each of the state government capex has not slowed down. Private capex has not picked up very well because of the fact that the corporate the tariff uncertainty continues to remain, and so as household capex. So अगर सब लोग बोलेंगे हाउसहोल्ड कैपेक्स क्या होता है, हाउसहोल्ड कैपेक्स इज मेजर्ड इन टर्म्स ऑफ लोन टेकन बाय हाउसहोल्ड फॉर asset creation. One such is auto loan, second is home loan. Home loan is the biggest part of that. That has slowed down, and given the rates are come down to 7.5% for housing loan, auto loan also will come down. Second half should do very well. And if you look at macro, global uncertainty remains very high. See, Europe is continues to remain a slowdown, and US has a very mixed. While everyone thought because of tariff the inflation will remain very high in US and there will be a slowdown, while tariff inflation remains very high in US, but there are mixed signals. The unemployment rates has not declined very much in US. Therefore, US continues to muddle around, and given tariff uncertainty, inflows of FII to India has been slowing down. So if you look at data for every day, it is the only the domestic institutions which are buying in the market, and FII continues to sell in the market. This is for the first time that domestic ownership of Indian equities, including mutual fund, insurance, today is equal to the FII ownership of Indian equities. So global uncertainty remains. So at some point of time, as Russia-Ukraine war gets settled down, uh, and geopolitical tension eases, I think FI money will come to India. So therefore, when we all argue, I'll come in my equity section where in terms of valuation, we will all keep arguing as a fund manager that markets are expensive. But I think Indian markets are bound to remain a little bit of expensive, one because of domestic inflows, and second because of FII at some point of time returning to India. India is a large market, large democracy, and it's the only market which has been growing. So this is the first part of my presentation. So I'll just summarize that macro India is doing extremely well. Micro India is looking to improve, given government focus on improving the consumption side of the economy. In terms of market, if you look at over longer period of time, both Nifty 50 return, Nifty mid cap return has been in line with the corporate earning growth. And if you look at Nifty earning growth has been similar to what the nominal GDP growth of India has been. So over a longer period of time, we had seen a nominal GDP growing at 10 to 11%, and similar has been the corporate earning growth, and similar has been the Nifty returns. So last 3 years, so last 12-month market has been consolidating, and prior to that, we have seen very unprecedentedly high returns. Those are unlikely to come. But given the depth of the economy, given that we are moving from 4 trillion economy to a bigger economy, given measure taken by the government, by the regulator, we feel earning growth for next 2 years could be very well. And I think within that, FY27 earning growth is going to be very strong, because all the benefit of bazooka of what the government has announced, what the measure government has taken, regulator taken, that will be felt in FY27 earnings. A small part will come in FY26. So if I had to look at consensus earning for Nifty and look at FY26, consensus are building in 10% earning growth. For FY27, consensus are building in almost like a 17% earning growth. So from that perspective, if I had to look at from a 2 year perspective, then we are here for a good return from the equity market, despite the fact that the valuations are rich and they will continue to remain rich. When I look at the Nifty PE multiple, it's trading above long-term averages. But just to highlight that Nifty has gone into multiple changes. Today, with the inclusion of stock like Zomato in Nifty 50, the PE is still is seeing a reduced relevance because all high PE stocks are getting into Nifty. Like Trend has gone into Nifty, Zomato has gone. These are a very high PE stock. That's why one need to look at uh, individual sector-wise valuation and look at the multiple. See, last 2 3 years has been an unprecedented. You buy any stock, any sector, you made a lot of money. But from here on, when the economy has consolidated, you would again see sectors which will be benefited because of the measure will do very well. Second, wherever the earning growths are very high. See, our markets to an extent had been now become mature market in terms of the every other new idea are getting discovered. In terms of many more new businesses are getting listed and are getting discovered. So just to give example, a few year back, a lot of fintech got listed. Maybe Paytm, maybe Policy Bazaar, maybe Zomato listed, uh, uh, and all these stocks had gone through different cycle, and the business have now been established, stabilized, and you could see that the markets have discovered value for each of the stock. Each of this fintech promoter never talked about profitability. Now everyone talks about profitability. So despite the fact that our markets are expensive, and they are expensive across the board. They are expensive even for mid cap. They are expensive for even for smaller cap. But one need to look at become more stock specific, more selective, and that will drive that will lead to earning growth. And in that context, that's why active funds become more and more relevant, because the fund manager will keep on looking at allocating to sector stock where the earning visibility are very high. If you look at mid cap, small cap, all are expensive. But within that, there are pockets where you see earning growth remains very strong, visibility of earning remains very strong, and therefore opportunity to make money remains on those pockets despite high valuation. The only risk to our market is sustained FII sales flow. Look, FII have been selling across the board. Domestic inflow remains very high, and that is what is leading to many OFS, many IPO, and many promoter sales. So to an extent, the supply in equity remains very high, so has been the demand, and therefore it is getting matched. At some point of time, you will see it's only the domestic institution or domestic flows which are managed, which are helping in the market, helping us to sustain this market. Had the domestic flows slowed down, you could have seen more correction in the market. If you And that is the only risk at this moment of time. But just to highlight that, when HDFC Bank Limited merger happened, giving an analogy, a lot of FI has sold because they had holding in both bank and limited. As the FI sell-off consolidate happened, earnings start coming back in the stock. You could see almost a large amount of FI coming back into the stock, and that phenomena will happen for the broader market as well. As the global uncertainty eases out, you could see FI money coming back to India, and that time we would see a further rally in the market. So you as a distributor has more important role now to play, or advisor to the client. As and when the market correct, it would be a right time to invest further. Our economy has been consolidating, and I think this year also it will consolidate. Government has taken measure, but FY27 is going to be a great year for us. Both earning growth will improve. Second, the base of FY26 is quite low. That will also help. So whenever the market correct, I think it will be an opportunity time to invest more money, to allocate more towards uh, equities. Also, one can start looking at SIPs. Second, we have seen sector rotation happening in the market. IT has seen a lot of impact. It has been a worst performing sector, whereas financials have been one of the best performing sector. This sector rotation will continue to happen, and that's why it is a role of active fund manager who keeps on looking at different sectors, keep tracking the performance and the earning growth in each sector, and keep churning the portfolio. So just to summarize, while macro India is doing great, growth has moderated due to challenges in the banking systems. RBI has been cognizant of this fact and has started taking measure. Consumption has two part, urban and rural. Rural is doing very well. Urban is seeing consolidation, and with the latest announcement of GST rate cut, urban will start doing very well. CapEx, central government CapEx remains on track, both central state. Household CapEx is moderating, but given interest rate has come down to 7.5% for home loan, we are very hopeful that the home loan will start pick up from here. Trump tariff impact. See, the impact will be on a very negligible part of the export we have, and specifically on textile, gems and jewelry, leather goods, as pharma is out of that tariff impact. So overall, if you see, the impact will not be a large part of economy, but in terms of job creation, it could have some impact in the unorganized sector. Second, sentimental wise, it can have a large impact. The only other variable one need to watch out for India is the job creation. If the job creation happens and continues to remain very strong, it will be very positive. So far, based on the data of last 6 months, we have not seen any large IT company adding any large people, nor is the financial institution adding people, and therefore job creation is the only variable one should look out. If that start picking up from here on, I think we are into a very good shape for the next 2 3 years from that. So I'll now spend a little more time on the value fund. I'd already taken almost like a 20 25 minute. I'll just spend 10 minutes on the value fund. So everyone thinks, what is value fund? Value, everyone thinks that buying cheap stock is a value. Uh, so you continue to buy a lot of PSU banks or PSU stocks which are trading at 5 6 8 multiple, that is value fund. I think what we have done is we have defined value in our offer document or scheme information document, and we have kept it a very broad so that it covers everything and doesn't restrict the fund from investing in restrict the opportunity size for the fund. Basically, what value the fund define is that 60% of the portfolio will be in companies as such where the trailing price to earning or trailing price to book will be lower than the last 5 year trailing PE or price to book value of that company. 60% would be allocated towards that, and 40% would be anything which is kept open. So even if I buy a stock which is trading below its last 5 year average PE or price to book value, and if the stock does very well, it starts goes up, then also it will be part of the portfolio, because then it will be categorized under 40% of the portfolio. Every month we look at this data point compared with the consensus data and look at the portfolio PE and price to book value, and based on that determine what part of the portfolio qualifies for value, what is not. As a regulation, we would since it is a part of my offer document said, it will be maintained, 60% will be maintained. This is the broad principle. Apart from that, how I look at value is into three buckets: absolute value, turnaround, and relative value. What do you I mean, everyone is thinking what is absolute value. So I'll just take example of company name to give you कि कहाँ absolute value होता है. But in any way, these are companies which are a part of my portfolio and they are all public information. But by any way, I'm not saying that one should look at buying this company. I'm just giving an example to use. So if I had to look at Axis Bank as an example, so Axis Bank at this multiple, it is historical low multiple. While the business has some challenge, but this stock offers absolute value at this price. And this is what how do we define absolute value, that the company is trading below its intrinsic value. So Axis could be a very good example of showing this. More stock which are part of the portfolio, which can be categorized as stocks which offer absolute value. I had taken some small cap, mid cap in the portfolio which offers absolute value. One such example could be a Karur Vysya Bank, which offers absolute upside in the stock. The stock could deserve to trade a higher multiple. So when I bought this stock, it was at absolute multiple. Today, the stock has rallied. So if you look at last 1 year, the stock has rallied, and therefore it will not be part of absolute, but it will go to relative valuation. So what is a relative valuation? Relative valuation is nothing but a company trading below his historical averages would be a relative valuation. So what are relative valuation? To give one example, could be uh, HDFC Bank. It is trading below its long-term averages. So there is a lot of relative valuation in this. All the tech companies today offer are trading below their relative valuations. Infosys, HCL Tech, all tech companies, they are offering relative valuation. And and last companies are turnaround company. So what are turnaround company? Companies which are facing temporary challenges in business, could be a capital allocation, just could be margin, could be temporary supply disruption, could be change in management. All this will be under temporary. These are the company which has been it's been impacted, and therefore when we say this, as normalization happens in the margin, in the growth outlook, change of management, capital allocation, they would have a very strong earning growth. This turnaround company are the one which will provide the big alpha to the portfolio. Absolute value one would also provide a larger portfolio, and relative valuation one are the one which will provide stability to the portfolio. So based on this, if I had to categorize the portfolio today, 30% of the portfolio are in absolute value, 30 are in relative valuation, and almost like 23 in the turnaround phase. And I had also shared the earning estimates for these companies. These are nothing but the Bloomberg consensus number. What is the earning growth for absolute value, for relative valuation, and for turnaround companies? And I had given the ROE of these companies. So certainly average turnaround companies would see a big growth. They're expected to grow at 26% CAGR in the earnings, and therefore would continue to be the largest uh, uh, driver to the portfolio over time. Because what we are building a portfolio is a bottom up. We are market cap agnostic. So over time, as we get more and more ideas in turnaround phases, we would like to increase the proportion of turnaround from 23 odd percent to 30-35%, so that it can provide the extra alpha to the portfolio. These are some of the portfolio positioning where we are overweight, where we are underweight. At this moment of time, we are seeing a lot of value in financials. They continue to trade below long-term averages, and outlook on earning growth remains good. Uh, this is the rationale why we are overweight, underweight in any of the particular sector, and this has been the performance of the fund. So if you look at, despite this fund being very old fund from 1995, it has been able to beat the benchmark, and that is what will our endeavor will be in terms of selecting stock, in terms of allocating stock, how to do that. Uh, this is the portfolio allocation.
So thank you very much for joining. We'll again let you know of such calls that we do periodic. So this is the perspective calls that we do at the mid-month, but we will come out with further notifications in terms of further calls. Thanks for joining, Anand. Again, thanks to you.
Perfect. Yeah, thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.